Hello everyone. We are back with a quarterly review of the bond market, what we think of the outlook going forward, as well as brief strategies on our various products. So increasingly, the local triggers for the bond market are getting more bullish. We have seen a cyclical slowdown in growth, and some of the outlier enablers of inflation are breaking down, so that the RBI now has been in a position to respond to this mix by cutting interest rates once, and we expect either in April or June for the RBI to move again. We expect a total of 75 basis points of repo rate cuts in this cycle, out of which 25 got delivered in February, and like I said, either in April or June we expect the next one. Turning briefly to the drivers for this, as I mentioned, growth, although reasonably strong, is experiencing a cycle slowdown, and therefore there is space for monetary policy to respond to this. Also enabled by some outlier items on inflation, chiefly with respect to food items, beginning to now come off, so that RBI now has better clarity of achieving its 4% inflation target. There has also been notable response from the RBI with respect to the liquidity situation. So to recap, somewhere around October, what we measure as core system liquidity was surplus close to 4.5 lakh crores, and this had diminished to almost minus 50,000 crores by January, which means that there was almost a 5 lakh crores of destruction of core system liquidity, even after the RBI had cut CRR in December by 50 basis points. That had infused close to 1,20,000 crores in the system. Now, most of this swing in liquidity was on account of forex operations of the RBI. So, as we understand, when RBI sells dollars to defend the exchange rate, it also correspondingly buys rupees, which destroys rupee system liquidity. After the CRR cut in December, which by itself was not sufficient to address the amount of drawdown of core system liquidity, we have seen RBI swing into even more vigorous action in order to supplement liquidity in the system. It has done close to 1 lakh crores of open market operations. Another 40 odd thousand crores are pending as we speak. It has done term VRR operations so as to provide banks with liquidity over the March quarter. It is also doing daily VRRs so as to ensure that banks are well supplied of liquidity on a day-to-day basis. And it is also conducted forward FX operations to infuse 6-month liquidity into the system. So as a result of all these operations, the market is now comforted that the RBI is looking out for liquidity. And also there has been a rub-off effect on the bond market because via OMO operations, RBI is effectively buying duration from the market, thereby creating replacement demand. So these are some of the very positive local bond market triggers. One should also remind oneself that some of the structural triggers for the bond market we have spoken about before remain very much intact. So the current account deficit remains of the order of 1.5% of GDP. The government has recently shown again the reaffirmation of commitment to fiscal consolidation. So not only have they projected a deficit target of 4.4% of GDP for the upcoming financial year, but they've also committed to resort to a debt to GDP framework, under which over the next few years they will bring down central government debt to GDP by roughly 1 percentage point per annum. The only so-called monitorable or a source of volatility for the local bond market today is actually emerging or emanating from offshore. So the so-called US exceptionalism trade, which is higher US growth, probably stronger US inflation, leading to stronger dollar and higher US interest rates, has been something of a worry for global bond investors outside of the US, to some extent in the US as well actually. Now here there is some abatement of pressure. So unlike market consensus expectations that with the coming in of the new US administration, it may lead to even stronger US dollar, even higher US interest rates, and even higher US inflation expectations. This is not panning out thus far. So actually US dollar has eased. US 10-year government bond yields have fallen by around 30 basis points, and market has had cause to reassess that some of the most bearish forecasts with respect to bond yields in the US may not come to pass. As far as India investors are concerned, that is good news, because if there is some letting up of global financial conditions, if the US dollar were to continue to ease and US interest rates were to continue to remain stable to falling, then we can hope for FPIs to resume inflows into India's bond markets as well. And generally, the tightness in financial conditions that is getting imported from abroad may start to also abate. There is one interesting point that one should remember. Unlike in equities, for bonds, FPIs were actually net buyers in the government bond market in January. In February, we have seen some more volatility. But like I said, if the global environment were to stabilize, we would expect FPI flows to resume as well. So in summary, local triggers for the bond market are positive. The RBI has embarked upon the rate cut cycle, and it's proactively infusing liquidity now, including through buying bonds from the market, which effectively is an additional source of duration demand. We expect another 50 basis points of rate cuts over the next 6 to 12 months. Meanwhile, the government has committed or renewed a commitment towards fiscal consolidation, thereby capping total bond supply. The global environment is a monitorable, but on the margin, there is good news there as well. In terms of portfolio strategies, we like or continue to like duration via government bonds. For the corporate bond curve, which is still inverted, we think up to 2-3 years is where the sweet spot is. So money market up to 1 year bank CDs, up to 2 year, 3 year corporate bonds is where we think the sweet spot is. Whereas, like I said, most of duration we continue to like government bonds for. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.